Hi, everyone. Thank you for joining us today for our Q&A, tax season Q&A, everything you need to know as a small business owner with Jeremy Doorn, a relationship manager at the Core Group. I just wanted to say a quick word about what GreenGeeks before we start. For those of you who are watching and are not familiar with us, we are a 300% green energy web hosting provider, which essentially means we put back 3 times the power we consume into the grid in the form of renewable energy. And we have been recognized by the US EPA since 2009 and a Green Power Partner. We offer share hosting, reseller hosting, VPS, and dedicated server. Now, moving on to this Q&A, please, you go ahead and put questions in the Q&A, so Jeremy will be answering them. We do have a few that were pre-submitted, so I'm going to read those first. But just, write them in the Q&A. And you can also chat in the chat room, but remember to select everyone if you want everyone to see what you're discussing. Also, as you know, we record this webinar/Q&A. So if you have to step away, we will send the recording to everyone in the next couple of days. And we have also enabled live transcription. I think we have. So you can now enable them by going to live transcript and then show subtitles. And now I'm going to introduce from our team at GreenGeeks, Erica. She will be assisting us with the chat and the Q&A. Hi, Erica. Do you want to say hi?
Hi, Anna. Thank you. Hi, everyone. My name is Erica Barbosa. I am from Costa Rica. I work in the partners team. Today, I'm going to be in the chat, reading your comments, sending some information. Hope you enjoy today with Jeremy. Thank you for being here.
You're welcome. Thanks for having me.
Thanks, Erica. And then Jeremy, I'm going to say a few words about you, and then I leave you, to talk about yourself. Jeremy is an enrolled agent with the Core Group. He's a seasoned tax professional with 13 years with the Core Group. And the Core Group, you can, maybe Jeremy, you want to say more about it, but it's your designated guide to help creatives grow and save money that is helpful, responsive, and friendly. It's the go-to accountant for all creatives. And we can call the shots for your accounting, tax strategy, and books, and you call the shot for your business. So Jeremy, would you like to introduce yourself before we start going through the questions? Say something about you.
Yeah, good. I'm good. Thanks for having me. Yeah, like she said, I work for Core Group. I've worked here 13 years. We do work with small businesses all over the country, mostly creatives at this point, videographers, different things like that. And we're your accounting guys that do bookkeeping, payroll, taxes. More than anything, it's about proactive tax planning, not just after the fact tax planning. So we can get into more of that once we get to some of the Q&A. I assume it's going to get into some of that. So I appreciate y'all having me here. And I'm in Tulsa, Oklahoma.
Great. Okay, great. So I'm going to read you the questions that were submitted before the webinar when we ask people to submit.
Yeah.
So the first question we have here is, I designed, host, and maintain a nonprofit organization website, but have not charged them any fees. Should I ask them for a contribution receipt for time and material costs to submit as a deduction when filing my personal taxes?
So I have to start with saying that all of the tax knowledge or information I'm going to give you is going to be fairly general. So if you want a specific tax advice, you're going to have to talk to your own personal tax advisor. I'll do my best to answer it the best I can, but any specific answers, taxes are obviously very complicated and everybody's situation is completely different. So I have to start with that. But to the question, if you've done work for a nonprofit or for anybody and you haven't collected any of the fees, through the business, you've already written off the expenses to go along with that, right? And if there's any time that you've maybe paid employees for, that's already written off as expenses through your business as well. So if you wanted to have it as a write-off, as a contribution to a nonprofit, you can't really do your time. The IRS doesn't recognize you giving a fair market value for your time donated. But the stuff that was donated, it wasn't really donated. It should be expensed through your business. So you already got the expense. So you really shouldn't be getting it on your personal side as an itemized contribution. So you can't get a double deduction for it. So if you're not deducting it through your business and you're keeping the stuff and maybe you're keeping it in inventory or something, then you need to make sure that you're expensing it. But as long as you expensed it and you don't have any income from that transaction, then you've already reaped the rewards of the expense of getting the expense. So can't do it twice.
Good. So another question we had here from pre-submitted. How do I know when my personal blog with Google Ads should be considered a small business? Does it have to make a certain amount of money in a certain amount of time? Are there other factors to consider?
So I mean, like if you look at, I think the IRS, like if you want a technical term on what the IRS considers a small business, it's anything from like 0 up to $25 million or something insane. So I think if you have a small business, it's a matter of, maybe they're asking whether or not they should report it. You're supposed to report all of the income you get, whether or not they give you a 1099 or whatnot. And so if you have a blog that you're creating money from and you have a profit motive, is really how the IRS looks at it as far as if it's a business or not. But if you have a business, it doesn't really matter how much money you're making. It really goes back to if you're trying to create profit. That's what business is in business for, unless you're not non-for-profit, that's a different thing. But if you're in it to make money, you probably have a small business, and it's probably time to start thinking about whether or not it's going to grow, or making sure you've got a good set of books and that everything's organized as far as your small business goes.
Okay. Someone has asked in the chat if we could place the questions in the chat that are not in the Q&A. So I'm gonna copy and paste this third one and a few others later here in the chat. Okay. So hold on, let me go. So this was from also someone who pre-submitted it. Does it make sense to contribute to an RRSP if last year's income was made only from being self-employed, but without being incorporated? And I pasted this question for you to read as well, Jeremy, in the chat.
Yeah.
If it
So
helps.
RRSP, is that what it said?
RRSP.
I guess I'm not familiar with what an RRSP is. Let me look it up. Okay, yeah, I figured it had to do with retirement. That's RRSP. They're either from, because I have a client that just moved from Canada. So they must be either from Canada or live near Canada or something like that, because I think they're talking about a retirement.
Right, okay.
Yeah, so I think everybody's situation is different. I think nobody's ever come to me and said, man, I wish I would have started sticking money away from my retirement later in life. So the more you can put, the better. And the only way you can stick your money into a retirement plan is if you have money from self-employed. So if self-employed or from a W-2 or something that has Social Security, Medicare on it. So yeah, I think it always makes sense if you can afford it. There's a lot of factors that go into whether you can afford it, how much personal money you need, how much money you have to contribute to it. So I think it definitely makes sense.
Okay, I'm gonna go over. Let's go over the three in the Q&A, and then I see there's one in the chat. But let's first read the Q&A. So about 2/3 of my income comes from a 1099 miscellaneous income from Google royalties, which my tax software creates as Schedule E. I still have Schedule C income and expenses. Would I be better off reporting my Google income as other income on my Schedule C? All income on my Schedule C sure makes reporting business expenses easier, which is otherwise I would need to split between Schedule E and Schedule C.
So my initial answer is, you reporting it on Schedule E makes it not subject to self-employment tax. And so if you have it all in Schedule C, then you're actually going to pay more in self-employment tax than you probably need to. So I think taking the time to split it between Schedule E and Schedule C is probably worth your while. I don't know how much money we're talking about, but yeah. So if you add it to Schedule C, it's going to increase your self-employment tax.
Okay. Okay, here we have another one in the Q&A. I'm nomadic with a permanent address in Ohio. I'm at the point of wanting to move from freelancing to a possible LLC. Where is the best place for me to register tax-wise? I've heard Puerto Rico or Costa Rica is ideal.
So that seems like more of an international question, which I don't really have any. I don't have any experience doing international, and registering an LLC from a tax perspective is, I mean, it would just, like in Oklahoma, it costs you $100. I think in Massachusetts, it might cost like $500 or something. So that doesn't really necessarily matter where you form the LLC, and the IRS doesn't even, they call them disregarded entities. So there's probably not a best place. I mean, it just depends on where. I mean, if you have a permanent address in Ohio, registering it in Ohio is probably the easiest. And then from there, if you're talking about international stuff, that's out of my realm. So I can't help you there.
Okay, we have another question here. Could you explain the qualified business deduction?
Yeah, so the qualified business income tax deduction, which was brought in, I want to say 2017, 2018, with the tax cuts from President Trump. And it basically allows you a 20% deduction of any of the business income. So income from Schedule C, from a partnership, from an S Corp, any of the stuff that ends up passing through onto your personal income tax return. It allows you a 20% deduction of that income. There's limits. There's also some specified services that once you get over income levels, you can't take the qualified business income tax deduction. So there is some limitations on how much that 20%, or if you can take part of it, 20%, or none of it, depending on what industry you're in and depending on what your overall income looks like, on whether you can take that or not. So.
Thank you. Another question here. I get paid through Interact e-transfers in Canada and usually get an email receipt of the incoming transactions. Is this a valid form of proof of income when it comes to tax season? What receipts will I need to provide and in what format?
Another international type sounding piece of information.
We have some Canadian, I think, people.
Yeah, it sounds like there's some Canadians in there. So, you know, anything, the email of the receipt of the incoming transaction, I mean, your bank account's also going to show where you received that income. And so all of those would be proof of income. You know, there's if you're receiving income, because as a US citizen, you're required to report your worldwide income. So obviously a company in Canada isn't going to issue you a 1099 or something. But if you were going to report that, you'd have to report all of it. And then there's some foreign exclusions and different things that go into that. But again, that's definitely out of the realm of what we do for sure. We stay within the United States for sure.
I see another question here in the chat. As a one-person web design business, is there any real benefits to registering a business and filing taxes that way, or better just to file as a self-employed individual?
Is there any real benefits to registering a business? So registering the business and filing taxes are two separate issues. And so like when you're a one-person business, you can operate as a sole proprietor, or you could register as a single member LLC. Both of them are taxed exactly the same on a tax return. So it really doesn't make any tax tax difference on whether you file under your social security number or whether you go get an LLC and get an EIN for the business. But like the name says, it's an LLC, so it's a limited liability company. So there might be legal reasons, and just in general, just to separate the business from yourself, going out and getting an LLC first because it's cheap and easy to do, and because it separates you from that business. So there might be some legal reasons to do that, and it's just usually a good idea just because it's so easy. Now, when you're an LLC or sole proprietor, there are certain income levels, and we might get into this later as the questions keep coming in. There might be a reason to make an S corp election, which then you can save on some of that self-employment tax as well. But for tax purposes, doing an LLC or doing a sole proprietor doesn't really matter. But I always tell people just go get an LLC just to create a separate bank account, just keep everything separate. It keeps everything clean.
Keep everything separate and clean. Another question. I own a hardscape business and have registered in the state of, I guess, New Hampshire as a sole proprietor. Should I register as an LLC? What would be the benefit of moving to an LLC? Similar to.
Yes, very similar. Yeah, very similar. So, again, I don't think it's necessarily a tax question on whether you register as an LLC. It's really a matter of just separating the business from yourself. You can, as you've done in New Hampshire, register yourself as a sole proprietor. You can also register as an LLC, and I don't know what New Hampshire charges for an LLC, but it's probably $100 or something. So for $100, you can separate it and then get a business bank account under the LLC and do all of it completely separate. So separating it from yourself, which I think just keeps, again, I just think it keeps everything clean. So, and there's not really any benefit to moving to an LLC besides the legal ramifications of keeping it separate from yourself and everything else, right? I think that's always good. In California.
Another question here. Yeah. In California, LLCs and S corps have a minimum tax of $100 per year. Not sure about other states. It's more a statement, I guess, than a question.
Well, and Oklahoma, you have to pay $25 a year as an annual thing to keep the LLC going. California, Texas, I think maybe has some LLC like minimums. They're almost like franchise taxes, just the price of doing business. But again, if it's costing you that to separate it, then it depends on how much money you're making, whether or not that makes sense for you.
Another question. I purchased an existing LLC in July 2022. Would I be able to retroactively make an S corp election for the 22 tax year? Great question.
Well, I don't know. There's probably some more information that we might need, but like if you started owning the company, then you're going to report from July to December. So your tax year is going to go from July to December. So you would have until September 3rd, 15th of 22 to make that election. And like, since we're now in 2023, you can retroactively make an S corp election. There are late elections that you can make, but you have to have been operating as an as an S corp, which means you would have to be paying yourself a salary through payroll. And if you weren't doing that in 2022, you can't really go back and pay yourself a payroll. So it is possible, but is it going to get accepted? I don't know if the IRS would accept it because you weren't actually operating as an S corp in 2022.
Thank you. Here we have another question. I heard you have to file taxes quarterly. Is that true? And when are they due?
Taxes are not filed quarterly. Income taxes, there are many different taxes. Payroll taxes are filed quarterly. The payroll taxes are filed quarterly. They're paid a little bit different, but if we're talking about income tax, they're not filed quarterly, but there are, if you have more than $1,000 in the previous year of tax liability, then you'd be required to make quarterly tax payments. And the 4 quarters, the IRS gets to make up their own quarters. So the first quarter tax payment would be due April 15th, and then June 15th, and then September 15th, and then January 15th of the next year would be the fourth quarter. So.
Okay. And I have a few other questions. We have one more. I never paid myself an actual payroll check. Am I hurting myself in any way by not doing this?
That's a loaded question, and I love it. So it really depends on how much money you're making. I mean, if you have a small business, and just for our purposes, when I'm talking to small businesses, like we talked about the S Corp election, I start telling people if they're making $40,000 or $50,000 of net income, that's income after expenses. So you have your revenue, you get your expenses, then you get your net income. So if you have a net income of $40,000 or $50,000 on Schedule C, it's probably time to start looking at making that S Corp election. But if you're still under that and you're on Schedule C, you shouldn't be paying yourself an actual paycheck. The only time you'd actually have to pay yourself a paycheck, an actual paycheck, is if you made that S Corp election. Then you're required to pay yourself like an employee, so you're required to pay a reasonable salary, as the IRS likes to call it. So you shouldn't, if you're still on Schedule C, you shouldn't be paying yourself a payroll check.
I'm gonna paste some of these questions here in the chat so everybody can actually also read them. Hold on. Okay. So this question is about write-offs. What is the limit on writing off certain areas in your house, Wi-Fi, electricity, stuff like that, working from home as a business owner? If you have a brick and mortar store, and maybe sometimes you work from home, how long do you have to work from home? How many hours do you have to have from home to be able to do the write-offs?
Yeah, so this is an interesting question. They're referring to having a home office deduction. So to have a home office deduction, it's not really the amount of hours or the square footage. I mean, to figure it comes down to square footage, and we'll talk about that. But it really comes down to whether or not this is like your place of business where you ordinarily see clients. Maybe you have a brick and mortar, that's fine. But if you see clients at the house or in your office at home, then you might be able to get that home office deduction as well. And so the limit, so there's two ways of figuring out your home office deduction. And again, the home office has to be, the IRS says it has to be 100% used for business. So that area can't be like the den in your house where you guys watch TV and sometimes a client comes over and you guys meet there. That's not exclusively for business, right? And so if you do have an exclusive business, then there's two ways of getting the home office deduction. You can do it the simplified method that the IRS came out with several years ago, which was take the area, the square footage of your home that you consider your home office and multiply it by 5. That one actually has a limit of $1,500 that you can have for a home office deduction. And then, or you can take actual expenses. So you would take your total square footage of your home office, total square footage of your home, and you'd come up with a percent. And then you would add up all of your electricity, your Wi-Fi, your mortgage interest, your real estate taxes, and all of that, and multiply it by that percentage and come up with that amount as the home office deduction.
Okay, I see someone asking what is Schedule C. If you could, for those who don't know, explain Schedule C.
Okay, so Schedule C is on your personal tax return. It's part of the 1040, which is your personal tax return. It's to report your business income. So Schedule C is where you report what your income and your expenses were for your business on your personal tax return.
Okay. I'm going to paste another question here for you in the chat. Let me see, did I paste it on? Okay. Okay. So I'm just starting out as an independent contractor, have a business account. Do I need a CPA to create a W-2 to pay myself, or is there a program that can do that for me?
W-2 to pay myself. So like I said, if you're on Schedule C still, and you haven't made an S corp election, you really shouldn't be paying yourself a W-2 first. If you are paying yourself a W-2, you don't necessarily need a CPA to do that. There are programs. There's Gusto. I don't know the prices on them. We process payroll, so I mean we can, anybody that's a payroll processor. There's Paycom, Gusto, QuickBooks Online will process payroll for you if you wanted to. So there are programs out there that will process payroll for you. But if you're a Schedule C, you don't need to be doing a W-2 for yourself. So
I'm going to paste another question here, so for everybody can read. What is the difference between marginal and effective tax rates?
Marginal tax rates are like your tax brackets. So there's like different tax brackets. There's like I don't know all of them, but 10%, 15%, 22% bracket. And so you get into those are your brackets depending on your income. And then your effective tax rate, because when they figure up those, they're like on a sliding scale. So your effective tax rate, you might be in the 22% bracket, which is your marginal rate, but your effective tax rate might be a little bit lower than that. It might be 19 or something like that. Or maybe you have some capital gains on there, so your effective tax rate goes down because your regular income is taxed up here, and then you have some capital gains that bring it down.
Okay. Another question here, pasting on the chat. On average, what are some good practices as far as writing off for most businesses?
So business expenses are business expenses, and what the IRS says, and what I tell people is they've got to be ordinary and necessary to business. If it's something that's ordinary and necessary to your business, then it needs to be counted as a business expense. So that's if I think several years ago they changed like cell phones. If a cell phone's used for more than 50% in your business, talking to clients, whatever you're doing on your phone, if it's used for more than 50%, then you can just write off the full amount. They call it de minimis. It used to be you'd have to figure out how much you use personally and how much you use business-wise. It's not like that anymore. You can just expense the whole thing. I think the home office thing, although typically it's a small expense, that's some of the stuff that people kind of forget about. There's mileage, stuff like that, but then anything else that you do to carry on your business can be written off.
Pasting here, someone had asked, if you are starting out with no employees and you're the only employee on average, what is the better choice, an LLC versus an S corp or anything else?
Okay, so so the LLC, as we talked about before, a single member LLC, that means it's just owned by yourself, is a disregarded entity for tax purposes. So it really means nothing as far as taxes go. The IRS doesn't even recognize it. It's a state designated entity. And so if you're just starting out and you have no employees, you shouldn't be paying yourself. So you're not really the only employee. I guess you're the only worker in this case. So having an LLC, I think that's a great place for everyone to start, is to get an LLC, regardless of whether you have employees or don't have employees. I just think it's a great place to start. The S corp is something, even if you had an LLC, the S corp is an election you can make with the IRS to end up saving on self-employment tax. And so you can have the LLC, and when you get to that point to make the S corp election, you can make that election. It doesn't change your LLC. It doesn't do anything. It just tells the IRS that your LLC is now going to be taxed as an S corp, and now you have an S corp tax return to do along with your personal.
Okay, another question here. I established an LLC in 2022, but due to a variety of reasons, I was not able to launch product services during 2022. Am I still able to deduct startup expenses even though I did not have any recorded income or profit?
I think that would really depend on whether or not you are continuing to try to launch it. I mean, if you have, so startup expenses, the way it works, and when you start talking about software and stuff, it gets a little hairy. But like, for example, like if you have a restaurant and you're opening a restaurant, all of the stuff that goes into opening the restaurant is considered a startup expense up until you open the restaurant. Then you can start, but all of those are actually put into one bucket called startup expense, and then you actually amortize those over 15 years, I believe it is. And then you start writing those off. Now, if you started this and you had a whole bunch of startup expenses and everything came crashing down, you're not going to continue and it's done, then you should be able to just write those all off as disposing of those startup expenses.
Mm-hmm. I'm gonna paste another question in the chat. What are the differences as far as taxes when it comes to hiring a contractor versus an employee?
Big time. So a contractor, when you're hiring a contractor, you don't withhold taxes, you don't do anything. You basically, if you pay them $2,000, you write them a check for $2,000. End of the year, you write them a 1099 for $2,000. That it's as simple as that, right? So there are no taxes when you're paying a contractor. Obviously, the contractor has their own set of taxes they have to deal with. But and then when you have an employee, if you pay an employee $2,000, you've got to pay FICA and Medicare match, which is 7.65%. So if you pay them $2,000, you got to pay them another. I mean, not pay them, but you got to pay the government. Payroll tax is 7.65% of that. And then you also have to pay unemployment, state unemployment and federal unemployment, which are usually pretty small numbers. So I usually tell people employees will cost you whatever you're paying them as far as payroll taxes go, you know, whatever you're paying them, whatever their salary is, plus 8.5% just for FICA and Medicare and unemployment.
Yeah. We have two questions, actually three, in the Q&A. I'm going to read them. With you having said that you should not pay yourself if you don't bring in over 50K in income, how do you pay mortgages in general, personal expenses?
If you don't bring in, that's a great question. You either don't have a mortgage or you don't have a whole lot of expenses. So yeah, I don't know. You live frugally, or you live somewhere in the Midwest that doesn't have a whole lot of the cost of living is fairly low.
You don't live in California.
You don't live in California. Trust me, I've been there, lived there. Yes, I agree with you, but people make it somehow.
Yeah. Okay, another question here. You've mentioned operating as an LLC is a good idea several times, but why? What protections does it offer, or in what way does it affect taxation? When I had a CA LLC at one time in the past, I still had to sign contracts and such with a personal guarantee outside of the LLC. Just trying to wrap my head around the pros and cons.
Yeah. So, yeah, I mean, the LLC, when you're trying to get credit or something, the LLC doesn't have any sort of history. So you might have to do a personal guarantee, but you're going to have to do that regardless of what you do. I can't speak to the protections it offers. I'm not a lawyer, so I can't give legal advice, but if you run it as a limited liability company, you keep business stuff separate from personal, then, you know, when people want to come after you, they shouldn't be able to come after you personally. But again, I'm not going to talk to the legal side of it. You'd have to talk to a lawyer about that. And so it doesn't affect taxes at all, is my whole point. But it does allow you to separate the business from yourself. So that to me is the biggest pro. Yes, there's some costs associated with it, but in most states, not California, in most states, it doesn't cost you a whole lot to just go get an LLC.
Here's another question. What's the minimum amount you have to make in order to be required to pay taxes?
So the standard deduction, I think this year it's gone up to, as a single person, it's like 12, almost 13,000. But so really, I don't know exactly what the amounts are, but it's somewhere in there. If you're a self-employed person, if you make more than $400 from self-employment, then you're required to file a tax return. And like if you made a W-2 for $12,000 and you had withholdings on it, if you can go get a free tax return, then you can get your withholdings back if they withheld anything from you, because you wouldn't be required to pay those taxes, but you can't get those taxes back if you don't file a tax return. So.
Okay. We have here another question. How to report income when part of your work and expenses is done in previous year, but only paid only this year?
So, well, that's a great question. So typically small businesses report on a cash basis. And so if you're reporting on the cash basis, then you report when the income is received and when your expense, and then you report expenses when you paid them out. Now it can get a little tricky if you have all your expenses last year and all of your income this year because of the way stuff paid out. And yeah, you'd have to figure out a way to maybe, I don't think you can. You can go to accrual basis and then have everything, as you accrue it, but then you're gonna have to go back and amend your tax return from the previous year if you had already filed it. So yeah.
We have here another question. There's a few in the chat, but I'm going to read the Q&A question first. If you aren't yet ready to make an S Corp election, but have profit from your LLC you want to use for personal spending, how do you identify it as an owner's draw / distribution?
Yeah, that's exactly right. So obviously if somebody has, you have to take out money to live on. And when you're an LLC, just taxed on Schedule C, and you want to take money out of your company, it's called an owner's draw or distribution. And I like to call it a profit distribution, because if the company's making money and there's profit, you're going to pay tax on the profit. The distributions they're not expenses, so they don't actually lower your income, but you're taking money out. So it lowers your cash, but it doesn't lower your income. And so it's a profit distribution. And so it's not going to get taxed twice for you to take it out of the business. You're already getting taxed on the profit. What you do with the profit is completely up to you. You can take it out personally, you can leave it in the business, you can go buy a boat, you can go do whatever you want, right? So that is a way to take it out. And again, those aren't expenses, so it's not going to get taxed twice.
Okay. I'm going to read this couple of questions that were placed in the chat. I have a one-member registered LLC that started making over 200,000 in the past 2 years. I do not pay myself on W-2, and I am disregarded entity for tax purposes. Should I be doing things differently, such as changing to an S Corp and paying myself and paying a whole lot of income and self-employment taxes? Very similar to the question.
So I don't know if the $200,000 is revenue or net income, but hopefully you don't have $150,000 worth of expenses to drive your income down to just 50. But like I said before, I start talking to people about making an S Corp election at 40 or 50 in net. So if you're at 200, it's time to look at an S Corp and reducing some of those self-employment taxes and getting yourself onto a payroll so that you can save that money for sure. And there's going to be a lot more tax planning that's involved in that as well. So.
Have I missed something? No, okay. So I'm gonna paste this question for you in the chat. Okay. Okay. So how do you estimate the amount you're supposed to pay in taxes yearly or quarterly?
Okay, so this is tricky, and sometimes I wish I had like a whiteboard or something to draw this, because sometimes it just makes it easier to see it. But your quarterly taxes are based on last year's filings. So like 2022 is going to get filed right now for 2023. When I file 2023 for 2022, if I have if I'm required to make estimated tax payments, like my software and most tax softwares that people use will, like if I have an outstanding balance of $5,000 for the year, it's going to break up that $5,000 into 4 quarters and tell me that I owe $1,250 per quarter based on last year's numbers, right? And so that means you would have that schedule for those 4 quarters. The problem then becomes, if you have a really good year, you probably are going to owe more in tax. So if you don't do any tax planning and don't work with somebody throughout the year, then you're never going to update those. You'll pay the $5,000, but you come to the next year to do your taxes and you had an even better year, you're going to end up owing even more in tax and going, well, I didn't see that coming. Or if you didn't do as well, then maybe you have even less taxes and you got overpaid. And I don't really like people being super overpaid or super underpaid. So what we do is I do the first 2 quarters based on last year, and then the whole second half of the year I work with my clients to adjust those 3rd and 4th quarters either up or down, depending on what's actually going on in the business and what we project out to do for the rest of the year, so that we're coming up pretty close when we come to tax time.
Sounds good. Here's another question. Is there a fine for failing to report quarterly if there is no S Corp, only LLC?
So the S Corp or the LLC doesn't really matter in this situation. It's not about, you don't report quarterly, you just pay those quarterly payments. Like I said, they're based on last year's. And if you were required to make them, so like I said in the last example, if you were required to make quarterly, like $1,250 per quarter for the entire year, and you didn't make those, then when you come to your next year's tax return, there would be there are penalties for failure to make quarterlies. They're typically fairly small, and they're nothing like jail worthy or anything. I've got clients that don't pay them quarterly and end up paying those. So, but there are penalties for not making your quarterlies if you're required to make them.
Okay, I'm going to paste another question in the chat. If you are an LLC, small business startup, and you're taking business trips, how do you write that off on taxes? How do you determine whether it's a business trip or not?
Well, I mean, if it's a business trip, then it's more time spent on business than it is for personal, right? So if you go to a convention or something like that, and it's business, you're going there for business, then if you've got an LLC bank account, then you start putting all of those expenses on your business bank account, right? If you go maybe you have some business to do in LA, and you're doing business on one day, and the next day you're taking the kids to Disneyland. If you've got 2 separate bank accounts, it's pretty easy. One day you're paying on stuff on this. When you're going to Disneyland, you're using the personal card, right? So it's just a matter of what are your purposes. If you're going there for vacation, then you're probably not on a business trip.
Right. Another question here. How would you know when you're required to pay quarterly?
So it's based on what your tax liability is from the prior year. So when you finish your tax return this year, you should know, either the person doing your tax return should be able to tell you that. Most softwares will just create them. When you use the tax software, it'll create them. So it's, like I said, it's $1,000. If you have more than $1,000 outstanding liability that you hadn't covered, then you'd be required to make estimated tax payments.
To make payments. Here's another question. I think it's both in the chat and the Q&A. If as an employer, we would like to pay the surgery of an employee, is this possible, and how would you be reflected in expenses or for tax purposes?
The surgery, I don't know that that's necessary and ordinary. You'd have to talk to your tax advisor on that, but the business can. It would just be a owner's distribution. So I don't think you can get an expense for paying for an employee's surgery. I don't think you could get an expense for paying for your own surgery, because that's more personal than it is business, right?
Yeah.
Yeah. So
I'm gonna paste another question. Yeah.
And you probably have to, if you pay for that surgery for the employee, you probably have to include it in their income, because anytime you give employee any sort of money, it really should count as wages, and you'll probably have to pay payroll tax on it, I imagine.
Right.
Yeah.
I'm going to paste here another question. If I am self-employed and typically pay taxes when filing, and I got married to someone who gets a W-2, but always gets a refund every year, is it better to file married jointly or separately? Will my partner lose his refund, and will I have to pay more taxes than before?
So this gets kind of tricky. So this is kind of personal. I'll speak to it generally. Generally, it's typically better to file jointly than it is to file separately. The tax benefits are typically better just for jointly than it is to go separate. There are personal reasons for wanting to file separate. I'm not going to stop somebody from telling me that they want to file separate because that's the way they want to do it. That's fine. I can show them that I can save them money. It doesn't really matter if that's the way that they want to run their personal life. And yeah, essentially, you know, you can work out with your partner if you had to. And I've had clients do this before, because with this exact same thing where I've got a W-2 spouse that has quite a bit of withholdings. And so when the self-employed person gets married to them, it's like, oh, wow, I don't owe a whole lot in tax. Well, you don't owe a whole lot in tax because that W-2 person already paid all that money in tax, right? So, you know, if you're not, you know, completely, or maybe you have separate bank accounts, you just get that you work out what a fair deal with, you know, how much that W-2 employee, maybe you should give them some money, maybe the business or somebody should give them some money for covering some of that, because yeah, your partner is probably going to lose the refund, and you're going to owe a little bit less in tax just because it's all filed on one.
That's a great answer. I'm going to paste another question in here. Which is better, a tax credit or a tax deduction?
Tax credits always. Tax credits are always dollar for dollar. Tax deductions are based on your effective tax rate. If your effective tax rate's 17% and you have a $2,000 tax deduction, you only get 17% of that tax deduction. It's only going to help you 17%, right? Because it's only going to write down your income by $2,000, and then you're going to pay tax on that. Tax credit, if you have a $2,000 tax credit and you owe $10,000 in tax, you're going to owe $8,000. So tax credits are always better.
Good. And here's another one. Can I deduct medical expenses?
Well, that's okay. You can deduct medical expenses if you itemize on your personal tax return. And then further than that, if you itemize and you have medical expenses, you can deduct the portion that is 7.5% over your adjusted gross income. So there are limitations on how much you can deduct. For sure.
And here's another question. Should I itemize or claim the standard deduction?
I think you should take whichever one's bigger. Would make sense to me. And that's what my software does. So like we'll collect all the itemized stuff that people have. There's not a whole lot of itemized things left anymore. And they kicked up the standard, they doubled the standard deduction in the President Trump's tax cuts or whatever they call that. So like you got real estate mortgage or real estate taxes, mortgage interest, charitable contributions, you know, donations to churches and for nonprofits, those sort of things. So if your itemized is bigger than your standard, take your itemized. If you don't get to the standard, which right now for a joint return is right near $25,000. So if you don't have up to $25,000, you should claim standard for sure.
Good. I have here another question in the chat. I have a small self-employed business after retiring from my day job. I was shocked to find out I can claim my Medicare premiums for me and my spouse filing jointly as a health insurance against my Schedule C income. Worth mentioning to the audience, I guess, asking if it's worth mentioning to the audience.
Yeah, I mean, if you're a self-employed person, you can write off your health insurance premiums that you pay, for sure. That is a deduction. Thanks for that input.
Okay, well, so I don't see any other questions here in the Q&A or in the chat. So I was thinking maybe we can wrap it up, and you can give an overall of what a business should look like for taxes in some generic wrap up, what to look in for taxes, business taxes in 2023 this year.
Yeah, so I think it's about, you know, registering it as an LLC or sole proprietor, doing either one. But then really just being organized. It's about having a nice set of books. It's about having bank reconciliations done for a business bank account. So keeping stuff separate in your business, making sure you're keeping track of what your income is or what it's going to be, so that you're choosing the right entity type as far as making S Corp elections, stuff like that. Having a separate business bank account helps keep stuff organized. I think those are all really good things to do right off the bat. And I would say fairly easy to do, but in California, apparently it's a little bit, it can get kind of costly. And then I think it's just about tax planning. That's what we're all about. It's about not getting these tax surprises at the end of the year. And if you're doing tax planning with somebody like Core or another, you know, accounting firm, then you don't have this worry. I find small business owners are always like, they just hate taxes because they just don't know where they stand. They don't know how much they owe. They don't know how stuff affects them. And so having that trusted tax planning partner to help guide them along the way is super important. And then the last thing I would mention is, you know, if any of the listeners have employees and have had businesses for the last several years, I'm sure you're getting emails about the ERC, the employee retention credits. I would seriously look into that. There can be some pretty big credits that come from that if you qualify. So I think those are all really good things but I think it all comes down to being organized going into 2023 and then beyond. Because going and giving your accountant a shoebox full of receipts at the end of the year doesn't, like, no, you would never know where you stand. And that's not helpful for you or your accountant, to be honest, right? So it's about being organized and really taking the business seriously.
Right. So this is something we already have to think for 2024, organizing everything for next year.
Yeah.
Already now at the beginning of the year.
Start now.
Right. Starting now.
For sure.
So, well, thank you so much. I wanted to ask Erica to share, I think you gave us a QR code to contact you. If someone has any question after this webinar, this Q&A, and they think about it, they can contact you through this, right?
That is correct.
Can you
Sure.
show everybody?
I don't know where it is. I don't have it, but there you go.
Yes, and yeah, so just in case someone has additional questions after this. And other than that, well, I wanted to thank you, Jeremy. You've been great. I love the questions and I love the answers. Very useful for me too. And for everybody else who's listening, just don't forget that we have monthly webinars as well as Q&As. So just stay tuned at greengeeks.com/webinars. That's where we list our webinars, but also we will be mailing you every month, as you know. And thank you, Erica, for your help. And if there's no other question, I'm going to let Jeremy go and everybody go.
Yes.
All right. Thank you, everyone. And we'll see you next month.
Enjoy the rest of your week.
Thank you.
Thank you.
Bye-bye.
Bye, everyone.